Uh, hey everyone, welcome. We're live on Zoom and we're also sound streaming concurrently on Clubhouse tonight. So by way of introduction, my name is Melissa. I'm a first-year MBA student at Kellogg School of Management and part of the Decoded team. For those who are new, welcome. I'd love to give you a little bit more background on what Decoded is about. Decoded is a community of ambitious creators and passionate builders. We're a nonprofit with roots in the tech and entrepreneurship community in the Silicon Valley. And we also teach entrepreneurship classes at Berkeley every semester. Over the past 5 years, our annual Decoded Innovation Conference has been the largest tech and innovation conference co-hosted by Berkeley and Stanford students and alumni with over 10,000 audiences every year. Some of our notable speakers include founder and CEO of Zoom, board member of Tesla and SpaceX, CEO of Y Combinator, and CEO of Google X. Our most recent conference last October. Oh, can you hear sound? No? Cool, thanks. Our most recent conference last October had garnered 1.3 million views across 44 countries and have thus prompted us to kick off this speaker series. Sorry. And today is our third session. And our next speaker will be on the 24th of February. So stay tuned for more details on that. And then to discover upcoming events, you can subscribe to our newsletter at decode.build. And then if you would like to volunteer with Decode on future events, please send an email to careers at decode.build. And on to the logistics for today's event. So after the fireside chat, there will be a Q&A session, and you can send in any questions that you have for our speaker via the Zoom chat. We'll try to go through as many questions as possible. And then for those of you who are selected to join our roundtable session with Jamie, you should have received an email from us confirming your spot, and we will be inviting you to join a separate breakout room directly from the Zoom meeting after the Q&A session ends. So, please stay around to receive that invitation. Is Shuo and Jamie here?
Yes.
Okay. So then I'll, go ahead and introduce our speaker tonight. Okay, so for tonight's session, we're pleased to welcome Jamie McGurk, Jamie's the managing partner of private investments at Coatue, an investment management firm with over 20 billion AUM across private and public investments. Jamie's primary responsibilities include the operations of Coatue's private investment business, which includes seed stage to pre-IPO growth stage investments across consumer, FinTech, and enterprise. Previously, Jamie was an operating partner at Andreessen Horowitz, where he led the corporate development and operating team. During Jamie's tenure at Andreessen, he assisted portfolio companies in raising 20 billion in equity and $2 billion in debt capital, $23 billion in M&A transaction value, and $12 billion in gross IPO proceeds raised in 437 closed transactions. Prior to Andreessen Horowitz, Jamie was an investment banker focused on the technology industry at Morgan Stanley and Thomas Weisel Partners. And this session will be moderated by Shuo Chen, who is the general partner at IOVC, a lecturer at UC Berkeley, and a faculty member at Singularity University. Without further ado, let's welcome Shuo and Jamie.
Thank you very much, Melissa. Really excited to be here. And thank you very much, Jamie, for making time on a Wednesday evening. Really excited to be chatting with all of you because Jamie has had such a fascinating career. There's so many things we can dive into. But to start, welcome to Decode, Jamie. And maybe to start, you could give everyone a little bit more background from your perspective, what your story and journey has been like.
Sure. Yeah. So thank you for having me. It's a pleasure to be here. I was actually, we were just chatting before, and I was saying about how I remember when I was in business school and undergrad, and having opportunities to listen to speakers.
And Jamie, sorry, just a friendly reminder to also unmute yourself on Zoom.
Okay, I'm going to mute myself on.
There is there.
Yep, that's perfect.
Okay, no feedback. Okay. Yeah, so I was, as I was saying, I remember, and I remember it was a long time ago at this point, but I remember when I was in undergrad and graduate school, having the opportunity to come and listen to speakers. And so by me participating here, I feel like I'm giving back and remembering fondly on that experience. So thank you for having me, and hopefully you get something out of it. Yeah, my background. So thank you for the introduction. That was a good one. I've had a professional background, has been mostly in finance my entire journey. So I started after undergrad at Morgan Stanley. I went on to work for a small family office in New York City, focused on private investing, so mostly venture investments. After business school, I was in investment banking, primarily like all tech from post business school on. And my last 10 years or so has been 8 years of that, 7.5 years of that has been at Andreessen Horowitz as an operating partner, and joined there fairly early on. Built and ran a group we called corporate development, which helped our portfolio companies with capital formation, capital strategy. So anything related to capital raising, M&A, IPO, anything along those lines, I help the portfolio companies with. And then at Coatue, I essentially function as COO of the private investment business. So Coatue as a firm is split between, it's a public hedge fund, 20 years in the public markets, probably about the last 8 or so years in the private markets, with both growth and venture. So I do a lot of the operational aspects of running that the private side of the business.
Perfect. I think a lot of folks are going to have questions around your thinking when you transition from investment banking as a career into really focusing on technology companies, and what it's like to not just be a partner investing, but also be an operating partner. So maybe you can talk a little bit about your thinking and lessons learned from early in your career.
Yeah, sure. So I would say, the investment banking. So at the time that I was in investment banking, it was, and I don't know how it is today, but it was like probably the most desired kind of path. And when I was in business school, especially, I would say about a third of our class went to consulting firms. About a third of our class went to investment banking, and a third went to various other things. And my view on banking was, and I still maintain this view, it was a great foundation and a great way to build a skill set, get a lot of responsibility, see a lot of things early, kind of be at the board level decision making, whether it's an M&A transaction, whether it's company deciding to go public. They're highly strategic decisions, and it's all of the inputs and analyses and the kind of thought process that goes into those decisions. So that was always my kind of line of thinking when I wanted to go do that. I didn't think I was going to be a career investment banker, but I did it for probably longer than I thought I was going to be fair too. So I did it for 8 or so years. But I still think that was a great foundation. And if I look back on my time there, not only does it equips you with a lot of skills, but it also gives you a broad set of skills where you can go and really do a lot of different things. I still maintain that view. That's not the only thing that equips you to do a lot of different things. And if you want to be in product management or technology, there's probably better routes to go. But I thought purely from a finance and transactional standpoint, there's probably and certainly as a segue into investing, it's one segue into investing. I think it gives you a great foundation, for if you want to go down that path.
What about in terms of lessons that you learned?
You're muted still.
Oh, how about now? Is this better? Okay, I think we're back on now.
There you go. Yeah.
So I was asking about lessons that you wish you would have known back then, things that you wish you had known earlier in your career, practices you could have adopted earlier.
Yeah. I think the one thing that I discounted at the time was how much serendipity played into my career path. And I think that's true, not just of myself, but of a lot of, people I know, and how did you end up where you are? And, it's, you can, I was kind of saying this before, you can draw a pretty straight line into, from what you've done to, what you're doing, and, hopefully to what you want to do. But I think there's an outsized role that both serendipity as well as luck plays in. Like, people ask me, like, well, how did you end up at Andreessen Horowitz? I'm like, well, to be honest, like, I was one of the first people at Andreessen Horowitz, and I was fairly early on. I was one of the first people that didn't work at Opsware, which was Ben and Mark's company prior to Andreessen Horowitz. And there was a lot of people that worked at Netscape before that. And even the people that didn't work directly there worked for the company in some way. So, like, for example, like our head of executive talent at Andreessen Horowitz he was a recruiter, but worked for Opsware, as his recruiting firm did work for them. So, like, everyone was kind of known to the firm. And I'll talk about serendipity. I literally sat on a plane next to someone who was good friends with the managing partner at Andreessen, who ended up being my boss, and just kind of randomly, like, connected us together. And that's literally how I ended up at Andreessen. And that to me is like, it's just like luck and serendipity, obviously married to, like, I had done a lot of relevant things that prepared me for that role, and they were looking for someone like me. But the actually getting introduced to the opportunity at the right time was, it was way more luck than it was anything else. And they didn't use a recruiter and go out and talk to 100 people. And so, so I would say the things that I would have appreciated then was just like, look, like, there's a lot of relationships, serendipity. Like, who would have known that this guy that I sat next to on a plane would lead to, a longer relationship that would have eventually led me to an introduction to this job that I ended up being in for 8 years. So that's what I wish I knew then. I probably would. I don't know if I would have done anything differently, but I probably would have been a little bit more relaxed.
I love that story, because I think it's easy for, especially folks who are earlier in their career, to think of their career path as one straight line, whereas serendipity actually plays a big role in terms of what things look like. Now that we're talking about Andreessen Horowitz, I know that you founded the operating team within corporate development. So maybe you could talk us through a little bit about what that was like.
Yeah. So I think using the word founder and founding is, it's a delicate balance, because, like, I think Andreessen Horowitz in particular, all of the GPs there were founders of companies. So I want to be careful with that distinction. But yes, like, they hired me to start the function. And, it was interesting. And the way that I described it then and the way I describe it now is exactly the same, which is, they, and I give them a lot of credit for this. And I wasn't the only one that this was the case for. So what they wanted to do was they built an operating function across lots of different disciplines. And they went out to hire experts in these different areas. And they kind of said, like, here's our vision, and here are, like, the guideposts. But at the same time, it was like, here's a blank sheet of paper, and you tell us how to do this, not let's tell you how to do this. And I give them a ton of credit for having that mindset of how they wanted to build the firm. And so it was a great opportunity for me, because it was like, when I thought about, like, okay, transitioning out of investment banking, it's like, okay, you do M&A, you do IPOs, and you do capital raising, and you do all these different things. And you don't always have the chance outside of investment banking to apply the full breadth of the things that you've done in a role like this. And so I thought it was a great opportunity for me. And at the same time, it was like, Mark and Ben and Scott Cooper and others there, hadn't done a lot of these things. And so they were not like, hey, this is how we want you to do it. They were like, look, like you tell us how to structure, you want to structure your team, tell us what you need. And so I really started with a blank sheet of paper, and built a team with a different skill set. I actually spent the first, I want to say like 3 or so months on the job there. I spent with our portfolio company. So at the time I joined, we probably had between 20 and 30 investments that had already been made. And so I spent time with the portfolio company CEOs who I was just meeting really for the first time, but were known and trusted Andreessen Horowitz. And so I spent time with them and said, hey, I'm starting this function. How would you use a function like this? What do you need most? And of course that evolved over time and over the years, but I took a lot of that feedback and structured the way that I thought would be most effective. And as the firm grew and as the portfolio matured, like what was most important changed a bit. So at the beginning, there were no growth companies, there were no IPOs, of course, just by definition, but that became important later on. And so not only was I able to kind of architect something from the beginning to serve the portfolio, but also like constantly evolved it to grow with the portfolio and the things that we did. And from what I did from day one, evolved a lot and grew a lot, and the breadth of what I did grew a lot, and that was great. And so just having the opportunity to do that and just to expand the things that we were doing alongside the portfolio. So for example, a few years in, I ended up hiring a startup CFO onto the team to be a CFO advisor. That's probably not something I would have envisioned from the beginning, but that became a really crucial role. One, because that was a very valuable service for our portfolio company CFOs to have someone who sat in their seat and to be able to advise them. But at the same time, it was valuable to us because there was a lot of data and a lot of information that we were able to get back from the portfolio. So I think that was a really interesting aspect of it as well.
Jamie, do you mind unmuting yourself on Clubhouse? Sorry.
I think you're muted.
Perfect.
Oh, here we are. Sorry.
So we're trying this thing where we're trying to do Zoom and Clubhouse at the same time.
I know. It's like a little bit
so
feedback.
I think I finally figured out the muting, unmuting stuff where I think when one person's speaking, everyone else needs to mute. And so when Jamie, you're speaking, I need to mute myself on both places.
Okay. All right. Well, you tell me what I need to do, and I'll try to do it.
So as I'm asking my question, you probably need to be muting yourself on Zoom and Clubhouse at the same time, and then
and then I'll unmute. Okay, got it.
Perfect. Thank you for sharing. I think for a lot of our audience members who are earlier in their career, whether they are coming out of school or they're young alumni, a lot of what happens within technology seems kind of, especially within tech ventures, seems like a little bit of a mystery because they don't get a lot of opportunities to interact with that during school. So it would be really great if you could share a little bit more about what day-to-day looks like, what your role looks like, as opposed to, say, founders who are running companies day-to-day, and giving them a little bit more context on that. And with that, I will mute myself.
Sure, and I'll unmute. Yeah, so I guess on the day-to-day, being on the tech investing side and working on the venture side, opposed to being in a company, is that the question? So yeah, so I would say, as an investor and going on the Andreessen Horowitz side, a big part of that platform is not so much, well, of course it is the GPs making investment in companies, but it's also, what are you doing for your portfolio companies after you make the investment, which was, a primary part of my job. So I think how it differs from a company, on a company, you're, first of all, the company is growing and building and scaling, and it looks very different year to year, even frankly, quarter to quarter or month to month. And on the investor side, if you're constantly doing Series A investments in enterprise, for example, you're coming across the same challenges over and over. So I'd say a big part of that is you have on the investor side, you have the experience of confronting a lot of the same challenges. So take go to market, for example, of the first motion of selling to large customers. what I did in the corporate development function of raising a Series A, or raising a Series B, or whatever the case may be. Like, you have the experience of learning of all these processes, having done them so many times. And so I would say that's a big part. Whereas if you're in a company, you're kind of doing everything for the first time and rarely doing things for the second time. So there's only one time you're going to raise the Series A. There's only one time you're going to raise the Series B. And what I think a lot of people don't appreciate as well on the company side is those are very different experiences. So going and raising a Series A is very different than raising a Series B, which is very different than raising a growth round, so they're going through all of these things one time and for the first time each time. And so I think the burden was on us to really impart a lot of that experience and knowledge and helping guide founders and guide companies through those experiences, having done it before. And that's very different. And, I think also the stress is a little bit different, I think. The founders, and we always had to remind ourselves too, of like, founders have one company, we have 100, right? So it's like, oh, well, this one's not going so great, or this one's, everything has its own challenges. Like, just reminding ourselves, like, this is their bet. Like, you have to kind of put yourself in their headspace sometimes of, and one of my primary responsibilities is helping them fundraise. One of the things I learned over time was a lot of times, sure, they need help with the tactics and the strategy and like actually raising a fundraise, or actually executing on a fundraise. But a lot of times they just need someone to coach them through, like, almost be their coach, be their psychologist, let them, like, everything's fine. This is normal. So, I mean, that was a lot of what we did too. And so we had to remind ourselves. So I don't for a minute try to believe that being a founder and on the company side, being on the investor side is the same as being on the company side, because it's very different. But, through those experiences, we can hopefully help founders and startup employees, like, having been through this experience before.
I saw a lot of head nods as people are listening to you walking through that whole process, even just coaching. What are some of the top tips or advice that you would share with folks who are aspiring founders who are thinking about how they can or structure their thinking, or how they can approach fundraising?
Yeah, so, well, on the fundraising side in particular, I would say the one thing that I found over, helping founders and helping companies through many fundraisers is, the preparation and being very thoughtful about, who you approach and when you approach and how you tell your story. The longer time is spent with preparation, the smoother the actual fundraising process tends to go. And that seems obvious, right? So, like, well, of course, like, why wouldn't everyone do that? Well, as it turns out, a lot of, companies going into a fundraise, like, they kind of almost accidentally get themselves into a fundraising process, or they'll say, oh yeah, I'll build the deck over this weekend, I've got this meeting on Monday. When actually, if you spend a few weeks or more putting things together and being thoughtful around not only how you're telling your story, but how others are hearing your story, I think that does go a long way. So.
And so I want to move on to your current role now as well, and understand a little bit better how you made the move, also shifting from Andreessen to your current role now with Coatue.
Yeah.
Before we talk about what we mentioned earlier with the innovations in capital markets, we'll come back to that last.
Yeah. So current role? Yeah. So essentially COO of a private investment, the private investment side of our business. So, for those that don't know Coatue, we're a large asset manager, 20 years in the public markets. So public markets hedge fund and private business that's been around for about 8 years. So, all the kind of operational aspects of running the private investment business.
So I wanted to make sure to cover that because we were in the middle of kind of walking through different stages of your career, and then
Sure.
kind of spent a lot of time talking about your role founding and running the corporate development team. So I wanted to ask, in all the different roles that you've been in across from investment banking starting, or rather debt capital markets starting with Morgan Stanley, all the way to where you are now, what would be some of the perspectives that you have on precisely what we were discussing earlier around capital market innovations? So we were discussing earlier about how in the future, your perspective was that there is bound to be changes in the IPO process and in fundraising. So would love to hear you share some of your thoughts around that.
Sure. Yeah. So I think the fundraising, like take it outside of kind of venture fundraising. So, kind of capital formation as it relates to the public markets has changed pretty significantly over the course of the last probably 2+ years. So I think really the advent of direct listings, as well as, even more recently, the advent of SPACs as an avenue to the public markets has been really interesting. So, I think that overall it's given companies a lot of choice as it relates to, approaching public markets. I've always thought, like in the direct listing process, my observation on the direct listing was it was really a decoupling. So there's not a fundraising event. IPO has been a fundraising event. So you raise money in an IPO and you're then listed on a public exchange. The big difference in a direct listing is there's no kind of capital raise, right? So it's just a listing event, and it's the decoupling of that capital raise with the listing, which I always thought made a lot of sense, because those are essentially two distinct events of raising around and listing, and so it kind of decoupled them, which I thought, I think that that's a much more elegant solution. Now you've got a SPAC, which is essentially, it's structured really as a merger. So it's a company that's merging into an already public shell company, and gaining a listing that way, which is, it's a product that's been around for 30 years, but it's really an innovation in how it's used with growth companies and tech companies and the like. And you're really just seeing that in the last, 6 months or so. And so that I think is really another interesting innovation. Now, I think these two different avenues to the public markets, direct listings and SPACs, I think they'll continue to evolve. I don't think what you're seeing today is kind of the end state, but I think that they're interesting alternatives to an IPO. I think that, the SPAC probably is more competitive with a later stage growth round, not necessarily an IPO, even though it's going to, take companies that would have otherwise gone public. Maybe it's, a year or 2 years earlier. But I think it's an interesting innovation, and I think you'll see it continue to evolve.
Perfect. I have one last question for you before I open up the floor for other questions. For anyone in the audience who has a question, feel free to start thinking about raising your hand or sending your question in chat. But the last question I almost have to ask you is, given your extensive experiences across startups as well as finance, what are your thoughts on more recent market phenomenon like with GameStop and some of these other stocks? Because there's always been this this conversation that it's almost pitting institutional investors against retail investors, and around ideas of, okay, if you're working with a lot of capital, are you just playing a capital's game, or are you really adding value to the actual company and the business itself? So would love to hear your perspectives, not limited to GameStop, but also just to reflect on this phenomenon that's emerging more recently about retail, the role of retail and institutional investors.
Yeah, so I don't think I should comment. I can't comment on any particular company or stock or GameStop or anything like that. But what I will say is, I think it's an interesting evolution. I think it's and frankly, I think it's a good thing. I think it's good to level the playing field a bit and have retail participation. Now, if the phenomenon of day trading and Robinhood and is more of a COVID phenomenon, or if it's a lasting thing, I think overall, if it increases financial literacy, one of the things I like about SPACs, frankly, is more of a democratization of the IPO process, where it gives a much broader swath of people the chance to participate versus just an institutional product where the traditional tech IPO basically shuts out retail. So if it's a phenomenon that levels the playing field, I'm all for it.
Perfect. And with that, I'm happy to open the floor to any Q&A. If you have questions, feel free to share that in chat, or feel free to raise your hand for questions as well.
Aditya?
I think the host might have to unmute him.
Yeah, thank you. And thanks, Jamie, for the insight. I'd just be curious to kind of get your thoughts on the IPO market and specifically the one-day pops we saw this past year. So think Airbnb, DoorDash, Snowflake, right? That basically had a 100% run up the IPO day and then had another 100% run up the first day of trading for retail investors. How should founders or late-stage VCs think about that moving forward when transitioning from the private to public markets?
So a lot's been written about this. So it's I think you can kind of go and see a lot of different opinions on it. One of the biggest reasons that I'm a proponent of direct listings and of SPACs is that there is it gives alternative to the traditional IPO process. And the traditional IPO process, to me, especially in tech, and really speaking more specifically about tech, because you don't see a lot of these IPO pops outside of tech. And I think there's a couple of reasons for that. You have a little bit of a oligopoly in terms of underwriters. So you basically see either Morgan Stanley or Goldman Sachs or both as the kind of lead left book runner. And maybe there's a few exceptions, but by and large, it's mostly those two underwriters or a combination of the two. And I think that leads to, and if you look at the way that IPO, the books are constructed, there's, the large mutual funds are, they're at the top of the list, and they tend to be, that top 10, and it doesn't deviate too much from that list. And so when you have that kind of dynamic where, you have the same buyers and essentially the same sellers, the same underwriters on every deal, you tend to see a little bit of the outcome be more predictable, which, it's fine if it's predictable and stable. It's not fine if it's predictable and you have all these big pops. Now, you can also argue that in the IPO process, only 10% of the company is sold, and there's a supply and demand mismatch and imbalance, which is also true. And I think that's certainly a contributing factor. But one of the biggest reasons that I'm a proponent of the direct listing is that you have a true market-based price. You don't have a hand-picked price with hand-picked investors. So I don't necessarily think it's the best way to go, but I also, I also think like it's a process that's been around for a long time. It works, and but what's right for any particular company will change. So for some companies, a traditional IPO might be the right answer. For some companies, a direct listing might be the right answer, and for some companies, a SPAC might be the right answer. And by the way, there may be a fourth kind of evolution that we don't know about yet that might come along. And so we'll see. But I think the innovation in capital formation, innovation in ways to access the public markets, it's all good, and it's all good for companies. And I'm glad that there's choice.
Yeah, and just a quick follow-up on that, because I know Bill Gurley's definitely talked a lot about this and the power of going public through either direct listing or SPAC. I know the New York Stock Exchange recently introduced something along the lines of a direct listing with capital raise. Do you think these alternative methods might eventually actually kill the IPO process down the line?
Shuo, should I take questions out of the chat?
Did you catch Aditya's last follow-up question, by the way?
I can't hear you.
Oh, I think Jamie might have not caught Aditya's last question. Do you want to ask a follow-up question really quickly?
Yeah, no, if that's okay with Jamie. Thank you for that insight. And I was just curious, because I know you mentioned that a lot of other people have written about this, Bill Gurley being one of them, who's been a champion for SPACs and direct listings. And in that regard, I know one other method of going public will be a direct listing through a capital raise. So kind of from your opinion, do you think in any way these alternative methods may actually end up killing the IPO process down the line?
I don't think they'll kill the IPO process. I think the IPO process will evolve, and you've already seen that happen. So if you look back to, this summer or fall, where, around the same time that, Snowflake went public, there were about 6 IPOs within a 1 to 2 week span. I think at least 3 out of the 6 had modified lockups. So, and one of the biggest knocks on the IPO was like this kind of limited supply and demand. And so the changing the structure of the lockup allowed for more supply instead of the 180-day lockup. So I think rather than killing the IPO, I think what you'll see is the IPO evolving over time. And you've already seen that. One example is the lockup. I think one of the biggest things that people point to in the direct listing and the SPAC is the ability to give forward projections. That's not possible today under the current construct of the traditional IPO. That could change. So we'll see, but I think it's far more likely that the traditional IPO will evolve rather than fade away in favor of a different method. And I think they'll kind of, you may see all 3 converge.
Thanks so much.
So I see some questions in group, but also I'm getting some direct messages with questions. So maybe I'll group some questions together for you so you can tackle multiple at the same time. So the first category is, what is your take on different startup pitches, whether it's in the very first round or subsequent rounds as they're raising, to try to pitch for all features or all different ideas all at the same time?
I'm not sure I understand the question.
I think the question that was asked in public group chat and some of the direct questions I've gotten is more asking if they should be pitching for like a minimum viable product with one specific focus feature first, or if it's okay for them to pitch the entire long-term idea and vision of everything they eventually hope to build out.
Oh, got it. Yeah. So, I think having like a longer term vision and having a, clarity of vision and mission and how you're going to build a very big company is important. But at the same time, having like a connect the dots type strategy of how you get there is important too. So like, I would assume that not having a big vision would not entail doing everything, in the seed round. But I think having a longer term vision, a big market that you're going to tackle and how you're going to build a very big company is important. So I wouldn't shy away from that.
So the second category of questions I'm getting well, actually, let me tackle this first group question first. So this question is really around what is the value of a pre-seed company? So things like MVP almost done, or solid product brand, or release upcoming.
Yeah, I think that's a tough one to answer. I'd say like, it depends on lots of different things. I think at the very early stage in seed companies, it's an evaluation of people and it's an evaluation of market size. And so, I think it just depends on the market in any particular time, the size of the idea, the quality and of the team. And so I think it's very hard to say.
Let me ask this last group a question in the group, and I'll ask you some of the direct messages I've gotten. So what are your views on growth market round pricings, especially recently between what's happening in the US versus in China?
In growth rounds. Yeah. I'm sorry, I'm getting some feedback. I would say that, it'll be interesting to see how it evolves from here on China, after what happened with Ant Financial and some of the more regulatory concerns. It'll be interesting to see how it evolves. I would say that China's a big enough market, and a lot of the players there, we do at Coatue is about 20% of our private investment is focused on China, and that's a market in and of itself. And so it's a massive market. I think it's the growth rates just domestically, in the market size domestically are large enough to build huge companies. And a lot of the companies that exist, both public and private, have been, there's very few examples of any crossover, like, any companies operating outside of China. So I think they're priced actually very similarly. but there is a bit of a regulatory overhang in China today. It'll be interesting to see how it evolves post-Ant.
I will ask you one last question before we shift into roundtable. So everyone who applied to attend the roundtable can ask you a question in person by turning on their camera and video. So the last question that I have for you from direct messages is, what are some of the practical advice you would have for folks who are early in their career who want to get ahead, whether it's a podcast or a newsletter or a regular kind of source of content that you can refer to that they can do to continually to professionally develop themselves?
Yeah, so I would say like always being an active learner, a voracious reader, like some of the things like being very deep and being an expert in whatever field it is that you choose. That's always something that I focus on. So I would say whatever my dad used to say to me, whatever you want to be, just be a good one. And so I think it's I think part of that is just being constantly learning, constantly evolving. The market moves really fast, especially in the markets that we're all in. So I would say just being open and flexible and always learning will definitely serve you well.
Perfect. So for those of you who applied and were accepted to the roundtable, I believe the moderator will start to move you into our breakout session. For those of you who never heard about this roundtable thing before, you can subscribe to the newsletter at the bottom of decode.build on the website, and the application gets sent out via social media as well as the newsletter. So if you're interested in joining the roundtable discussion and asking Jamie questions in person, you can apply over there. And with that, thank you so much for your time with us, Jamie, here on the main stage. And we'll see you in the roundtable discussion.